Okay, guys. Well, happy Monday. We will go ahead and get started here. We got a short week. Hopefully, everybody's got some good plans for the fourth. Um, n- Not a lot of news this week, but a big report. So we've got a new Fed chair, and we've got some inflation readings since Fed Chair Warsh took over. The next big report that hits the wires is the monthly jobs report this Thursday. The markets will close early Thursday and they're closed Friday because Friday is when we're observing the holiday. So I don't think you're going to see a lot of market movement interest rate wise this week. If the jobs report came in hot or cool on Friday, normally that will be a market mover. I'm sorry, Thursday. Normally, when it comes out on a Friday, it moves the markets. This week, I don't think it'll move the markets much because I think traders will either already be in the Hamptons for 4th of July or they'll eventually be on vacation. But I think it could cause rates to move some next week. It feels like the jobs reports have been trending a little bit better the past 2 or 3 months after starting out the year really weak. Um, and so within the jobs report, what the markets are looking for is what they call wage-based inflation. So are wages going up higher than what the Fed likes to have as their target? That could be seen as a sign that's, inflationary, which could cause rates to move higher. That's typically why mortgage rates move up when the jobs report's strong, is if there's any like wage-based inflation. Um, what happens over the next few weeks is we'll make a big deal, not just on what the Fed does, but what the Fed says at their next meeting. And I'm going to share my screen because we've been talking about this Fed Watch rate kind of prediction tool. And right now, and this changes literally by the day, sometimes by the hour. I think last week, there was about 60% or so expecting the Fed to do nothing at the meeting in July. That's now up to 70%. The rate cut expectations were 40, now they're down to 30. Well, I'll show you guys this every week for the next month or so until the next Fed meeting, because this will be all over the place. Um, there still are some expectations of a Fed rate hike later in the year. You can see that like 59% of those polled, 47 and then 13, so more like 60, are expecting a Fed hike by September. And again, if we get a Fed rate hike, that's not necessarily bad news for mortgage rates. If the Fed hikes, that means they're trying to fight inflation. Inflation staying moderate is good for mortgage rates. So something that'll be interesting to watch. I think the biggest difference between prior Fed administrations and the new Fed chair Warsh is if we look back over the past 20 years, maybe 25 years, it really started with Alan Greenspan. Kind of after the dot-com bust, it continued with Ben Bernanke during the financial crisis and really continued all the way through Jerome Powell and during COVID. And that they called it a Fed that was more interventionist. And what they meant by that was the Fed would use tools at their disposal outside of hiking or cutting rates to move markets. You'd hear terms like QE, quantitative easing. Um, you're going to start to hear a term QT or quantitative tightening a little bit over the next few months. I want to make sure everybody understands what that is. So, if the Fed is easing monetary policy or QE, quantitative easing, they are throwing cash into the system. They are artificially stimulating the economy. They are artificially pushing rates lower. They are buying mortgage bonds and treasury bonds, by the hundreds of billions of dollars. They did that post financial crisis. They did that during COVID, and that artificially pushed rates lower. Um, During the financial crisis, when the Fed did it, the recovery on the other side didn't really cause inflation. And we had an interventionist Fed after the '08 crash that artificially drove rates lower, put a lot of cash and liquidity into the markets to kind of prevent a Great Depression, if you will. But inflation didn't spike for many, many years after that. The Fed was very interventionist, and then they slowly pulled back starting in like 2012 or 13. We know what happened during COVID. You had a very interventionist Fed. a lot of QE cash being pushed into the system that artificially pushed rates lower, but then it also caused significant inflation, the highest inflation that we saw in 30 or 40 years. And so the Fed is trying to kind of backtracked a little bit the past couple of years. There's a term you might have heard of called QT or quantitative tightening, which is the opposite. That's when the Fed is pulling money out of the markets. Um, you might hear a term called balance sheet reduction or balance sheet runoff. And basically, that just means that the amount of money the Fed has got pumped into the market buying bonds, mortgage bonds, and treasury bonds, as bonds mature, they won't continue to put more money into the market to replace that. Um, I think you're going to hear a lot of talk of QT with this Fed chair because he is not an interventionist. He wants the free market to do what the free market does, and he doesn't want the Fed to have to get involved and artificially move markets and push rates artificially lower. Um, what do you think will happen if the Fed takes more of a QT or quantitative tightening stance, i.e., not buying mortgage bonds, not putting as much cash into the system? Do you think that would cause interest rates to go up, or do you think that would cause interest rates to go down? Does anybody have an opinion? All right, so Jennifer's got a yes, it'll cause rates to go up if inflation goes up. Interesting take. All right, anybody else want to throw it out there? There's no wrong answers. Um, All right. So generally speaking, if the Fed is implementing a QT, quantitative tightening, balance sheet runoff, those all kind of mean some or somewhat similar things. That would typically cause mortgage rates to go up. And why would that happen? It's supply and demand. Okay, so think of it like this. What did home prices do during COVID? They went up. Why did they go up? They went up because of supply and demand. They didn't go up because of low interest rates directly. They directly went up because of supply and demand. Now, why was the demand for real estate so hot during 20 and 2021? Certainly, low interest rates was probably the main reason. But the reason why prices spiked from 2020 to 2022 so rapidly, 25% appreciation nationwide, big numbers, it's because low rates, but really it's the demand that it caused, and significant increase in demand pushed prices higher. So what happened with interest rates during COVID? The Fed became the massive buyer of mortgage bonds, hundreds of billions of dollars of investment, QE, quantitative easing, significant increase in bond buying. What did that do to bond prices? It caused them to go up. And when bond prices go up, rates go down. And so the opposite could happen if the Fed implements QT, and they have been doing some of that over the past couple of years. But Fed Chair Warsh might do it to a greater degree than his predecessors. So if we implement a policy of QT, of quantitative tightening, balance sheet runoff, again, it all kind of means the same thing. The big buyer, right? So let's use a real estate analogy. In many markets, hedge funds and institutional buyers were massive buyers between 2020 and 2022. That caused an increase in supply. When those institutional buyers pulled out of the market, that caused a decrease in demand. A decrease in demand softened prices. And so if the Fed implements QT, less demand for mortgage bonds, mortgage bond prices go down, interest rates go up. So if you hear QT or quantitative tightening or balance sheet runoff, any of those buzzwords that we might hear more and more of with the new Fed chair who has a little bit different opinion on how involved the Fed should be, typically that means higher interest rates, right? Um, at the same time, this Fed chair is a believer in lower interest rates. And so he's in a they're all in a difficult situation. It's certainly not a job that, is you would take if you want an easy, cushy job. But his belief is a non-interventionist Fed, quantitative tightening, less artificial pushing rates lower, but he wants rates lower. And so this chart is going to be really easy to watch here. And I think everyone's predictions are going to change every single day. But what you could see is quantitative tightening, the Fed stepping out of the market, artificially pushing rates lower, but then cutting interest rates as a balance. But you're going to hear a lot over the next few weeks, and this Thursday's jobs report will be the first major report that could influence what the Fed does in July. So for the past 6 months, or I guess 3 or 4 months, we've kind of been on Iran war oil watch. The next 2 or 3 months, we're going to be on Fed watch. And what economic reports say and how that will impact the Fed to move. I think everybody wants lower interest rates. And I think Fed Chair Warsh was nominated by President Trump, who is, there's no secret that he wants interest rates lower, especially heading into election season, midterm elections in November. So it'll be interesting to see what levers does Fed Chair Warsh pull to try to push rates lower. But it might be different than what his predecessors did. His predecessors would just flood the market with hundreds of billions of dollars of cash to buy bonds and push rates lower. He might have this same goal, but go about it a little bit of a different way. So this will be interesting to watch. And I think one thing that's important for us, all these things we talk about on these calls is understanding the information, but then how do we explain it to our customers? And if the Fed hikes the Fed funds rate, we all have to be in a position, and not the day it happens, but in the days and weeks before it happens, we have to make sure we're communicating, one-on-one in meetings, on social media, videos, that a Fed rate hike does not necessarily mean mortgage rates are going to go down. And the closer we get to this July 29th date, the more accurate these predictions get. We'll know probably 10 days before the Fed meeting what they're likely to do. And we'll talk about it on these calls a lot, but I think it's important that we communicate that proactively to our customers. And so we want, when our customers see the Fed hike the Fed funds rate, I want all of my clients to be the expert at the office. And, they're talking around the water cooler office like, oh, you see the Fed hiked rates today? I want my people to say, well, my mortgage guy, Mike, told me that that actually means mortgage rates are going to go down, and here's why, right? And so we want to make sure we get that information in front of people. If we look at the bond market chart, it's been relatively positive the past couple of weeks. So this was the beginning of the Iran war, and we've had a couple times where the market sold off, higher oil, increased inflation fears. But the worst of that ended about a month, maybe 6 weeks ago, and we've been in decent rally mode since then. We had kind of a temporary pause where the market sold off for a little bit for about 10 days or so. But it seems like the ceasefires, despite, a couple missiles being, shot off over the last couple days, it seems like for the most part, the ceasefire is trending in a positive direction, and oil's down around $70 a barrel. If you guys remember when we first started talking at the beginning of the Iran war, oil immediately spiked. Oil is a leading indicator. It takes a little while for inflation to start to show in the economic reports once oil spikes. So if you remember, it took probably 2 months from the 1st of March until we started seeing higher inflation readings. Now that oil is coming back down, it's also going to be a leading indicator with inflation coming back down. And so if oil continues to trend lower, the next reports after this Thursday's jobs report are going to be the June inflation reports that'll be released in July. And we want to see inflation trending lower, but we probably won't see it in July. We probably won't see it until August, because it takes sometimes 30, 60 days before it really shows up in the system. But positive trends. So we're moving in the right direction. We're a lot of room to go still to get rates back where they were before the war started. You're still probably 0.4 to 0.5% in interest rate higher than where we were at the beginning of March. All right, I've got a couple interesting charts and graphs that I pulled up today. And again, as always, if you guys want copies of these, just message whoever you work with on our team. We'll get these in your hands. So the first here, and it's interesting because it shows the difference between the median sale price and the average sale price. And you can see historically, going back to 2001, there was a small gap, like the average sale price was always higher than the median, but they tended to trend in the same direction. And the difference between average in green and median in blue was about the same, historically, the same percentage. That started to change in 2022, and it's continuing to widen. And so why is that? We've talked for many, many months on this call that there's two different markets for home buyers. There's the younger first-time home buyer type, and so they have less work experience, so they're maybe more likely to be worried about their job stability. They have less time that they've been able to save, so they don't have as much cash in the bank, and so they're less likely to buy a house because they're not as stable financially. And so, we've talked about the average age of a first-time home buyer has gone from early 30s to late 30s, pushing 40 over the past couple years. That's why, like Dave said, K-shaped economy, right? That's exactly what's happening. And you're seeing it in the average sale price and the median. So the median is the same number sold above or below, but the average is take them all, add up all the volume of real estate divided by the number of closings. And the average is substantially higher than the median, more so than it's been in 25 years, because more and more houses are selling at higher price points. And that's kind of the two economies, or the K-shaped economy, that you're older, more established, better job history, more cash in the bank, 45 years and up, most likely, consumers are much more stable financially than younger people. That's not a surprise, but younger people, the first-time homebuyer market, um, historically, yes, they're less economically stable than older people because they're younger and they haven't had as much time to create wealth and build savings. But it's more the mental concern of, um, is their economic situation stable? Is their job situation stable? And they're more impacted because they probably don't make as much as people 20, 30 years older than them. They're more impacted by inflation, like higher cost of gas impacts a 28-year-old more than a 48-year-old. And so this was interesting, and I think this just continues to show that who are the clients that are taking action, that are buying houses. Like when I look at our group's average sale price and loan amount, it continues to go up even when the median price is flat to slightly down because of who's buying houses. Um, and what's the most common type of transaction we're doing right now? We're doing a lot of move up buyers, right? Buy before you sell, non-contingent upon selling. They've got a little cash to put down. They're okay carrying two mortgages maybe for a period of time. Like a first-time home buyer is not comfortable doing that. So just interesting data. I think we all know this, but the data kind of confirms it as well. I've got a couple other things here that were interesting. So this chart here shows the percentage of transactions that you're seeing seller paid closing cost. I think that's interesting to see. This is a very market by market number. Um, and most of us are in the Southeast, and we're in more of a buyer's market, than maybe the Northeast. Like in Nashville, I think leads the country right now. What I saw, it's like 90% of transactions are having some kind of seller paid closing cost. Nationwide, the number is 46%, but compare that to, it's double from 3 or 4 years ago. Um, in New York, which is a really hot market right now, very limited inventory, it's 3%. Um, so this is something that I think is a good tool to share with sellers, because there's probably a 50-50 chance that your seller is going to get an offer with the buyer asking for some type of closing cost credits. And so when we're doing net sheets, like, sale price minus, standard closing costs minus commissions, you probably anticipate 1, 2, or 3% in closing cost credits, requested from the buyer. So some interesting market data. Again, these are all things that we know, but it's helpful to have the data and the visual to share. I've got two other topics, and then we'll wrap it up for the day, and wish everybody a happy 4th of July week. So um, does anyone know what occupancy, so primary residence, second home, investment property, does anyone know what occupancy allows you to purchase a home in an LLC? Okay, this is a pretty easy question, so I'm expecting we're going to get a lot of right answers here. So what occupancy allows you to buy a home in an LLC? So primary residence, second home investment. Okay. All right. So we got an investment. Okay. And Brent, technically you're right, right? Technically it could be kind of any. Okay. But most commonly it's investment properties, right? And so I want to walk you guys through a couple LLC scenarios because we get this question a lot. So if I'm buying an investment property, the two most common ways we would finance that would be conventional mortgage, so Fannie Mae or Freddie Mac, or DSCR, right? DSCR is kind of the hot button in the industry. Um, if someone asks us the difference between the two of those, so the most common answer would be one requires more documentation, right? DSCR is like credit, verify their down payment, and project what the house is going to rent for. A conventional investment property, requires pay stubs, W-2s, and tax returns. Um, but sometimes the conventional loan might provide a better interest rate. So if I can get someone a better interest rate, conventional compared to DSCR, and I can verify their income, like why wouldn't I do a conventional mortgage if I can get better terms for the customer? And so that's a conversation that like our whole team has with all investors. Like, here's a couple of different ways to finance it. Here's the pros and cons of each. Here's how they work from a documentation standpoint. Um, but there's a misconception about Fannie Mae. So does Fannie Mae allow you to buy a property in an LLC? Does anybody know the answer to that question? Okay. And I got Brent giving me the visual.
If you,
So,
you count a trust, an LLC.
well, no, no, yeah, no, just an LLC. Okay. So I think everybody probably knows, and most realtors probably know, the answer is no. You cannot buy an investment property with a conventional mortgage in an LLC. Here's the point I wanted to make today. So, can you transfer the property into the LLC immediately after closing with a conventional mortgage? And the answer there is yes. And for a long time, the answer was yes, but you're taking a risk. Okay. And so I'll map this out for you guys. So, up until a couple years ago, if you bought an investment property in your name personally and you transferred it into an LLC at a later date, technically the servicer could call your loan due because it was not specifically allowed to put into an LLC. Now, the reality was if I bought a house in my name, I transferred into like Mike Smalley LLC, a couple of weeks later, was the servicer going to call my loan due if I was making payments on time? Probably not, right? But there was always a risk that you could. Um, but a couple years ago, Fannie Mae and Freddie Mac both specifically in their guidelines said specifically you are allowed to transfer your property into an LLC after you purchase it in your name personally. So Brent could buy it in his name. He can transfer it to Brent LLC after closing. And there's a few parameters like he has to own the LLC that he transferred it into. So it can't be like, Brent buys it in his name and we transfer it into my LLC. Like that'd be a due on sale clause. Um, but here's the negative with that. Even though you can do that, you're going to have to pay doc stamps. And that varies a little bit by state. But typically in Florida, they make you pay doc stamps on not the full sale price, but maybe half the sale price, or they might make you pay it on whatever your loan amount is. So we've had a lot of people ask about buying properties in LLCs for various reasons. Typically, it's some type of asset protection. Just know that almost all programs allow you to ultimately get it into the LLC, but there might be a cost. And so this is a common question your customers may ask like people on our team if they're buying investment properties. They might say, what's better, DSCR or conventional? Let's just say that I can totally qualify them either option. And let's say a conventional could be a 6.5% rate and a DSCR might be 6.75. You might say, cool, go with conventional. It's a quarter better interest rate, right? All things being equal. Um, that might be the case, yes, but if their intention long term is to transfer it into an LLC, you might be better off doing the higher interest rate DSCR that wouldn't require you to pay doc stamps And we had one the other day. It was going to cost them $2,000 in doc stamps to transfer it into the LLC after the fact. So even though conventional was a better interest rate, we did DSCR because it was like a $50 a month payment savings compared to a $2,000 cost. And we felt like that we'd rather have the $50 higher payment than have to pay 2,000 of additional out-of-pocket expenses. Um, anyway, so I just bring that up. That was a lot. We don't expect you guys to be mortgage people, but the LLC DSCR, how do I take title? It's kind of a hot buzz right now that we're getting that question a lot, like why would I do one versus the other? So we thought it would be appropriate. Um, and ultimately that all goes down to asking questions. So I'm going to give you guys a quick example of a real world story. So one of our loan officers had someone the other day that another lender had done the traditional, 30-second phone call, go to my website and fill out this application. And our loan officer did it a little bit differently, and they took the application over the phone. And here's the difference between the two. So can you ask someone their long-term intention of how they want to take title on the online application? You can't. Um, and this specific person, and this wasn't an investment property, but this was someone who's relocating. But can you ask the person their motivation for relocating from another state to Florida on an online application? You can't. Can you build rapport and ask them how they met their realtor on an online application? They can't. You can't find common ground like kids and hobbies and where you're from. We all like to look at someone's area code on their phone. Um, in Orlando, you're typically 407 or 321, and a lot of people we do mortgages for aren't a 407 or 321. So we like to Google their area code if we don't already know it, figure out where they're from, and make some common ground and build rapport, and that's rapport we can share with you guys. And so the point being is the LLC questions, like understanding which is better, it all boils down to asking good questions up front at an initial consultation. And that isn't just for DSCR and conventional investor comparisons. That really goes for all types of mortgages. That you can't get all the information you need online, and you still have to have a conversation and ask good, like thought-provoking questions where you peel the onion back. Um, Last thing I've got is a sales trip, and then we'll tip, and we'll try to get you guys off here right on time. So um, I think most salespeople would agree that it's difficult to keep in touch with their past clients beyond closing. Sometimes we get busy and we don't think about it, and then like 6 months or a year or 5 years has gone by, and it's like, what do I say? And so I mapped out kind of a strategy that we like to use, which is like a 5-touch post-closing campaign a few months back on this call. Some of you guys might have been on it. But a lot of us did first payment calls for customers at the end of last week. And, we typically call them a couple days before their first payments due, just to make sure that they're set up in the portal, and we service most of our loans, so it's pretty easy to tell someone, here's your link and loan number, and it's kind of an easy conversation. But for realtors, if you guys are looking for a reason to call after the closing to kind of set up that like client for life relationship, um, making your post-closing call, like, yes, you're probably talking to them a day or two after closing, but when their first payments due. It's, you skip a month. So May closings, it's July 1st, June closings, it's August 1st. You're not calling them about their first payment. You're not helping get them set up in the portal of how to make their payments on time. But it's not a bad time to reach out 30 to 45 days after closing. What we found doing that, it's a good customer service touch point. One, it's a great time to ask for feedback, testimonials, and referrals because they're not as crazy busy as when we're asking for testimonials, like when they're trying to get utilities, hooked up, and or they got a moving van in the driveway. Um, so if you don't have a touch point 30 to 45 days after closing, one we found to be really successful as a first payment call. And even though you're not calling to help them make their payments, around that time seems to be a really good time. So if you're not doing that, we like to block off the last Friday of the month for that. and you can touch everybody who closed the month prior, and it's just a great touch point to then set it up for like a longer term, client for life type of relationship. All right, guys, with that, thanks for jumping on today. Have a great week. Have a great weekend, and we will nobody blow off any fingers. Hopefully we're all, 10 fingers and 10 toes next Monday, and we'll see you guys next Monday. Thanks, everybody.
Perfect.